All right, let's get started. Today, I'm going to share with you the top 4 index funds to buy and hold so you can win at the stock market. You're not going to want to miss this. You heard right. You only need 4 funds to buy and hold long term in order to successfully invest in the stock market. In fact, investing legend Warren Buffett agrees that using index funds is a great investment strategy because it allows you to take advantage of the success of major corporations without the risks associated with picking and buying individual stocks. Specifically, the top 4 index funds I'm going to share are: number 1, a domestic stock total market index fund; number 2, an international stock total market index fund; number 3, a bond total market index fund; and number 4, a high dividend index fund. Owning these 4 funds allows you to put together a well-diversified portfolio with extremely low costs and have the ability to easily manage your money for years to come. What are the names of each of these 4 funds? How should you allocate your index fund portfolio? I'm going to share with you the answers you need to know and the most important things to consider about your money. If you haven't seen my first video, all about banking basics to establish your money flow, then watch that after watching this, because you have to have the basics set up before you can begin investing. Quick disclaimer, this is for educational purposes only, and you should consult a fee-only fiduciary financial planner if you still have questions about your personal situation. Now, the names of the 4 funds, if you invest at a place like Vanguard, are VTSAX. That's Vanguard's Total Stock Market Index Fund, which is designed to provide you with exposure to the entire U.S. stock market. This includes small, mid, large cap, growth, and value stocks. The fund's key features are its super low costs with a 0.04% expense ratio and broad diversification. Essentially, you're investing in the entire U.S. stock market, owning a small portion of over 3,500 stocks. Next is VTIAX. That's the Vanguard Total International Stock Index Fund, which is designed to provide you with exposure to both developed and emerging international economies. This fund tracks stock markets all over the globe with the exception of the United States. It has an expense ratio of 0.11%, and because it invests in non-US stocks, the fund can be even more volatile than VTSAX. The third fund is VBTLX. That's Vanguard's Total Bond Market Index Fund, which is designed to provide broad exposure to U.S. investment-grade bonds. This means it invests in U.S. Treasuries and mortgage-backed securities of all maturities. So we're talking short-term, intermediate, long-term. Many investors can consider this their core bond holding with a low expense ratio of 0.05%. Generally speaking, bonds are less risky than stocks, so holding a portion of your portfolio in bonds can help offset the volatility of the other 2 stock market index funds. Finally, the last fund is VHYAX. That's the Vanguard High Dividend Yield Index Fund, which is designed to provide broad exposure to U.S. companies that are dedicated to consistently paying larger than average dividends. This fund focuses on slower growing, higher yielding companies, so it's a great dividend fund to buy and hold long term with an expense ratio of 0.08%. To be clear, the first 3 funds are ideal for retirement vehicles like a Roth IRA, traditional IRA, a 403b. The 4th fund, the dividend fund, is best in a taxable brokerage account because it helps to create a passive stream of investment income. How you allocate your retirement portfolio is going to vary from person to person. This just means that the more time you have until you plan to access these investment accounts, the more aggressive you can be in your allocation. For example, this 3-fund portfolio within a retirement account like a Roth IRA, it might consist of a combination of something like 64% total stock market index, 16% total international stock index, and 20% total bond market index. for someone who is in their 20s and has decades until retirement. This allocation is based on the old rule that people should hold their age in bonds. Or another way to think of it is the percentage of stock you hold in your portfolio is 100 minus your age. So in this case, 80% stocks and 20% bonds for someone 20 years old. This old rule is very conservative, so many have adopted the revised rule of 120, which is for those with a higher tolerance of risk because it calculates your stock allocation as 120 minus your age. The next decision is what percentage of your stock allocation should be US domestic stocks and what should be international. This comes down to personal preference and is much less critical of a decision because US and international stocks have similar risk and long-term returns. One thing you might want to consider is target date funds, which we haven't discussed yet. These have been increasing international allocation over the past decade, so you can look at those as a guide or to get a good idea of what percentages might work for you based on how long you have until retirement. Speaking of target date funds, these are available for people who don't want to have to decide how and when to allocate their money. For example, the Vanguard Target Retirement 2030 Fund holds over 30% in bonds because it's designed for people who are going to retire in the next 10 years or so. On the other hand, the Vanguard Target 2050 Fund holds less than 10% in bonds because it's designed for people who have more than 30 years to retire. Target date funds use a very similar investment strategy as the one we're discussing today, but the rebalancing and allocations are all done for you. That means as you get closer to retirement, your bond allocation increases and your stock allocation decreases automatically. Some people love the simple automated aspect of target date funds, and you usually pay a slightly higher expense ratio because all the work is done for you. Just keep in mind that you can buy all the same funds inside a target date fund on your own and usually save money in fees. And by the way, for those of you just starting out, you can purchase the ETF version of these funds if you don't have enough money to meet the minimum initial investment amounts. That's a really good tip for someone just starting out. So look at the ETF versions if this applies to you. Likewise, Vanguard is by no means the only place to purchase these types of index funds. Fidelity, Schwab, Rowe Price, they all have their own versions of these low-cost index funds, so do your own research before investing. I'll include a link down below to example 3-fund portfolios from each of these other companies. Personally, I choose Vanguard because they have some of the lowest fees, and Vanguard has this unique structure in terms of how the company is owned by its shareholders. So essentially, when I invest in Vanguard, I own part of the Vanguard company. It's pretty cool, right? Okay, moving on. The dividend fund I mentioned earlier, VHYAX, is an index fund I hold in a taxable brokerage account. The dividends paid provide a steady flow of investment income, but to be clear, I'm not withdrawing this money. Rather, I am buying and holding, and this is set up as a drip investment account. So I reinvest the dividends back into the account, buying more shares with the dividends. To be clear, a brokerage account is not something everyone needs right away. For example, if you haven't maxed out your retirement accounts, your HSA, you still have student loans, maybe you have kids and you want to start saving money in a 529, all of these areas of your life might take precedence over investing in a brokerage account. However, as you earn more money, over time, a brokerage account will become necessary. And a dividend index fund like VHYAX is a great way to invest in hundreds of larger than average dividend paying stocks, all within one fund. Okay, let's recap. Buying and holding index funds within a retirement vehicle like a Roth or a traditional IRA is an investment strategy recommended by some of the world's smartest investors, like the legend himself, Warren Buffett. A 3-fund portfolio consisting of a domestic stock total market index fund, an international stock total market index fund, and a bond total market index fund allows you to buy a small portion of the entire world's economy. You can allocate these assets so your stock positions are much higher the more time you have to invest. Then, as you get closer to retirement age, you can increase your bond position to decrease the volatility associated with owning stock funds. Through Vanguard, my domestic stock total market index fund is VTSAX. My international stock total market index fund is VTIAX. And my bond total market index fund is VBTLX. These index funds have very low fees and help provide a diversified portfolio. Similar funds are available to purchase in ETF form if you're just starting out and don't have enough money to meet the minimum initial investment amounts. Likewise, companies like Fidelity, Charles Schwab, Rowe Price all have their own versions of these types of index funds as well. When you're ready to open a taxable brokerage account, a high dividend index fund like Vanguard's High Dividend Yield Index Fund, VHYAX, provides a steady flow of larger than average dividend income. It's a good idea to set up drip investing so that the dividends are reinvested back into the account. This is a surprisingly powerful tool to improve your investment returns over time. If you want to learn more about index funds and investing, I'll leave some links down below to a couple of fantastic books on the subject. All right, let's wind this thing down. I know so many of you are still in survival mode right now, but I wanted to offer some suggestions on how to invest for the long term, especially when things start to improve. I have an announcement. Here in the Smith house, we are expecting our second child in a few weeks. It's a very exciting time for us, and I'm planning to pre-record a few videos in case the baby's early. If you have suggestions for what kind of videos you want to see, please let me know in the comments. Some people have asked about business credit cards or saving for college funds. Whatever you would like to see, please let me know and I'll record those videos for you. That'll be a really big help to me, so thanks. If you are new to the channel, please like, subscribe, and ring that notification bell. It means a lot to me. You subscribing really gives me the encouragement I need to keep making these videos, so thank you. Also, we launched a private Facebook group for people who love talking money and helping others learn about finances. Feel free to join, and you can help craft exactly what this community is going to look like moving forward. All right, as always, I'm Rich, and until next time.